On.
Hey class, Mr. V here. These are the learning goals and success criteria for this video. If you're watching this in class, awesome. If you're watching this outside of class, please don't watch it on YouTube. Please watch it on Edpuzzle. That way you can answer the questions as you go along. All right, so for this video, what you're going to learn is to add basically this term depreciation into your accounting vocabulary. I'm going to show you these learning goals and success criteria again a little bit later. Most of the way through the video, you're going to answer your first set of questions, and you're going to have to, pardon me, just explain the difference between some of these terms, like what's depreciation expense versus accumulated depreciation. Then at the end of the video, you have to answer some questions where you're actually going to calculate how much is the depreciation. You're going to learn two methods in this video. In part one of this video, you're going to learn straight line method. In part two, you're going to learn declining balance method. All right. So first things off, I'm going to get into what is depreciation and how to use just the straight line method to calculate it. So depreciation as a word implies a decrease in value. All right. So depreciation in accounting, this is the process of us taking the value of an asset like a car worth $5,000. It's a cheap car. It's the kind of car I would buy. And each year, you would have to acknowledge by expensing the amount of this car that you have kind of used up, because cars tend to decrease in value over time. So if the value of this car has decreased by $1,000 in a year, the idea of depreciation is that we would have to expense $1,000 to depreciation expense. And then we're going to do something using an account called accumulated depreciation, which is going to change the value of the car on our balance sheet to not add $5,000 to our total assets, but instead to only add $4,000 after the first year. All right. That way it's going to be a little bit more accurate. We're not actually going to change the number next to car because the cost principle says we can't do that, but we want to be accurate. Okay. So that's basically what depreciation is in a nutshell. All right. Now, what kind of assets depreciate? Equipment tends to decrease in value over time. A building often does. Technology, furniture, cars, all that good stuff. So in calculating depreciation, what we need to do is, well, not always, but using certain methods, we have to know its useful life. How many years is that car actually going to be good for? So in this video, when I say useful life, that's what I'm talking about. All right. So let's get into what depreciation actually is. So I'm going to show you how to do straight line, and that's a good way to learn what depreciation is. So we want to calculate how much a asset that depreciates actually depreciates. All right, we have to estimate it a little bit. All right, so let's say you want to calculate the annual depreciation expense on that car. Well, in the example I just gave you, I said the cost of the car was 5K. And I said that the car was good for, I said decreased by $1,000. So using straight line method, that would imply that the car is good for 5 years. So imagine you're just given a problem where you're told that a car is worth $5,000. It's the cost of it at the beginning, and it has an estimated useful life. We estimate that the number of years will actually help the business earn money. It's about 5 years. After that, the car won't be good for the business anymore. And you need to make an adjusting entry to actually put down how much is the depreciation expense for this year. Well, you would just simply use this formula: cost divided by years, $1,000. Using straight line. This is a simple example of straight line, but that's just how much you would depreciate the value of the car. All right. So that's the first thing is actually calculating that depreciation. Okay, we're going to make it a little bit more complex, but that's basically it. So what would the journal entry look like? Well, this is what the journal entry would look like for that example that I just gave you. All right. So again, we have to actually put down depreciation expense due to the matching principle. So that's why in this journal entry, you can see we're debiting depreciation expense, just like supplies expense or telephone expense, wages expense, salaries expense, everything you've been seeing for adjusting entries. This is just another one. So in this case, it's depreciation expense that gets debited. You might be wondering, well, why aren't we crediting then the value of the car? So the car was worth 5,000, and we're saying that it's been used up 1,000. Why don't we just credit car for $1,000? Why instead are we creating this new account called accumulated depreciation? So I'm going to get to that very, very shortly here. Okay. All right. So here's another example. Here we have a $5,000 piece of equipment bought on October the 2nd. Today is October the 31st. Time for an adjusting entry. All right. How do we make it? Well, here you're told in the question that the car has an estimated useful life of 5 years. Now, if you're just saying that we need to do depreciation expense as our debit, and accumulated depreciation, which again I'll explain in just a sec, as our credit for $1,000. Slow down, because that implies that a year has gone by, but a year has not gone by here. Only a month has gone by. So what we would do is we would just convert years into months. So 5 years is equal to 60 months. We know that over the course of the useful life, this car is going to depreciate fully by the $5,000. So what we would do to calculate this number is we would take that value of the car. It's straight line depreciation method, so we just assume that it depreciates by an equal amount each month, and we multiply it by 1/60 because 1 month has gone by. Okay, we bought the car on October 2nd, and it's October 31st. Let's say each month it's with a monthly accounting period. Then we're going to make the same exact journal entry for $83, which is 5,000 times 1/60 every single month. Let's say instead we bought this on September. Oh, sorry, it's still October 31st. But let's say we bought on September 1st, and today is still October 31st. Well, now 2 months have gone by. So to find the amount, instead of 1/60, you'd multiply it by 2/60. And that would be, what, $167, I think. All right, so it's very simple, the journal entry. We calculate how much depreciation has occurred, and we expense depreciation for that amount, and we credit into this new account called accumulated depreciation. So here's a little bit more on accumulated depreciation. Basically, again, if you were thinking, well, why not just credit the equipment? You can't do that because of the cost principle. All right, if you were to instead here, if you were to credit equipment, so let's say you didn't credit accumulated depreciation, you actually credited equipment. Well, here's what would happen. On the balance sheet, your equipment, which was worth $5,000, if you credited it for $83, the value of that equipment would go down to $49.17, right? Which is 5,000 minus the $83 of depreciation for the first month. But you can't do that. The cost principle says you're not allowed to actually decrease the value of the equipment. The cost principle says this number has to stay at $5,000 forever because that was the initial cost when you bought it. So instead, we're creating a new contra account. It's really the second contra account you've seen in this course. The first one was HST recoverable. A contra account is sort of like a smaller account that we attach to like an asset or liability account. And a contra account has the effect of decreasing the value of that main account. So for example, when we did HST recoverable is contra liability because it was attached to HST payable. So HST recoverable would just go right underneath, and HST recoverable, whatever that number is, it would decrease the debt for HST payable by a little bit. Same thing goes here. So under equipment, we are just going to, in this example, since it's the first month, we'll create accumulated depreciation. And we're going to put down $83, right? Because we credited accumulated depreciation for $83 here. All right. And then it's going to create something called the carrying amount. So how much is this car or this piece of equipment? Sorry, I always mess up with car. How much is this piece of equipment actually, how much should it be worth on our assets? Well, it should be worth $49.17. So this is called the carrying amount. And this is how much will be added to total assets, which I'll show you in just a very quick second here. Okay. Let me show you now. So here we have an example. So if you can look, it's very small. Sorry for that. But here you see the long-term asset is furniture. And the furniture was bought at a cost of $51.20, which is this number right here. All right. Now, over the course of however much time since we bought that furniture, it's depreciated. The accumulated depreciation is $13.86. So the amount that this furniture, let me get rid of that. The amount that this furniture right here originally bought for 5120 is actually going to contribute to our assets is not 5120, but the carrying amount, which is your furniture minus your accumulated depreciation, which is 3734, that's how much actually gets added to our total assets. All right. So the good thing about depreciation is whatever that capital asset is sort of now worth after depreciation, that's the number that gets added to total assets, which makes a lot more sense. To show you that a little bit bigger, you can see this slide right here. So that example we just did, equipment. We have to keep this forever at $5,000 due to the cost principle. Accumulated depreciation after 1 month is $83. And then we have this carrying amount, which is the amount that will actually get added to total assets now. But this number, accumulated depreciation, will get bigger and bigger. So here it's only $83 because only 1 month has gone by. But after 2 months, this number will now say 167, which will make the carrying amount even smaller. And then after 4 years, this will now say $4,000 after all that depreciation happens. And this carrying amount will then be down to $1,000 after 4 years. So the actual carrying amount that gets added to total assets gets smaller and smaller over time. Last thing I want to show you is what if it's an asset that doesn't go down to zero? So in that example I gave you at the beginning, where I said like it's a car worth $5,000 with an estimated useful life of 5 years. Well, that assumes that after 5 years, that car is worth $0, right? Because it's depreciating by 1,000 a year, right? But we don't necessarily want to do that. Sometimes you're going to be given something called the salvage value. So salvage value is the estimated amount that a depreciated asset will be worth at the end of its useful life. So here's an example, okay? It's in other words, how much your business will get for an asset. So let's say you're told that furniture is worth $1,400 when you buy it, but it will have a salvage value by the time it's done of $200, and it has an estimated useful life of 6 years. So we would tweak the straight line formula just a little bit to look like this. Instead of just doing cost, the way you learned it before was just cost divided by estimated useful life would equal your annual depreciation. When we have a salvage value, instead, as you can see over here, we do cost minus the salvage value, which is how much we'll get at the end, divided by estimated useful life equals depreciation annually. So in this example that I've given you down here, $1,400 is the original amount. So instead of just doing 1,400 dividing it by 6 each year, we instead do 1,400 minus the salvage value 200 divided by 6. Because at the end of the 6th year, the end of its useful life, we're still going to get $200 for the furniture. Maybe we'll find someone to buy it, and by that time, it'll probably be worth about $200 in salvage. All right. So here, the annual depreciation expense would be $200, right? Because it's $1,200 divided by 6, and each year would be $200 of depreciation. Okay, that's a lot of info. I'm sure you're doing awesome. We're almost done the video. We just have to talk about the change in declining balance, but you've really learned the main part. So let's test this first success criteria. Can you explain the meanings of depreciation expense and accumulated depreciation? Okay, so try these questions. We'll take 5 minutes to do this in class. Okay, so the end of this video is just to hit up our last success criteria, which is calculating depreciation using not only straight line, which you can hopefully now do, and you'll have a chance to try that in a second, but also declining balance method. All right, so what's declining balance method? Well, the sort of trouble with straight line is, again, that car worth $5,000. Is it really accurate to say that each year, that in year 1, 2, 3, 4, 5, etc., that it decreases by 1,000 each year? Not really. A car probably decreases by a lot more in its first year than in future years. So some businesses, for the sake of accuracy, choose to use declining balance method. Now, if you use declining balance method, instead of just decreasing it by the same amount each time, instead you would decrease it by a percentage. So instead of decreasing it by 1,000 each year, you would decrease it by 30% each year. Okay. What's the value at the end of year one? Well, it'd be the 5,000 minus 30% of 5,000. What about the end of year two? Well, you would take whatever that new value was and subtract 30% again, then 30% again in year three. All right. So these subtractions will get smaller and smaller and smaller. The first year, it might go down by $2,000. The second year, it might only go down by whatever 30% of 3,000 would be, which would be $900. And this number gets smaller and smaller and smaller. So I'll show you an example and hopefully some good sense. I hit pause and kept talking. I do that often. Okay, so all I was saying there is that, well, how much? Where do you get the percentage from? Like, how do we know what percentage to depreciate our car by? Well, the Canada Revenue Agency gives us these suggestions. So they might say, so they suggest for cars 30% a year. If you bought a building like after 87, they say you should depreciate it by 4% a year. Computer equipment, they say depreciate it by a lot, 55% a year. Okay, maybe because it gets used up or more quickly than, let's say, a car. But whatever the case is, those are the numbers that we use in accounting. All right, so let's try an example and see what it looks like. Okay, so I'll just show you what it looks like actually, and then you can do the example for yourself. So here is straight line depreciation, and here is the new one, declining balance. So let's take a little peek at straight line first. So here it's the same good, by the way. The good starts at $22,000 either way. So with straight line method, you're told here that this good has a salvage value of $2,000. So you're told that it is a capital asset, original value of $22,000. You're told it has an estimated useful life of 5 years, and you're told it has a salvage value at the end of the day. We'll be able to scrap it and sell it for $2,000. So you would figure out How much do we depreciate it by each year? You just plug into the formula. 22,000 minus the salvage value 2,000 divided by the useful life 5 years, so it'll be 20,000 divided by 5. That's why it depreciates by 4,000 each year. All right, and after each year, here's sort of the new value. As you can see, the new value, the carrying amount goes down each year. All right, so that's what it would look like with straight line. With declining balance, it's almost simpler in its own way. All you do is you take the original amount and you multiply it by the rate given to you by the Canada Revenue Agency, which is 55%. So each year you take what the new carrying amount is, multiply it by 55%. So let's assume that it was worth $22,000. Let's assume you bought it at the beginning of the year. To calculate depreciation for the first year, you're just going to multiply it by 0.55. All right. So the first year, 22,000 times 0.55, as you can see, is $12,100. So your journal entry for year one would just be the same as with straight line. Depreciation expense for $12,100. Okay. And accumulated depreciation for $12,100. For year two, so that was year one. For year two, well, the piece of equipment is now worth, the computer equipment is now worth $9,900, right? Because in year one, it started at 22 and it decreased by 12,100. So the carrying amount is 9,900. So you take 9,900, we're on the second row now. You take 9,900, the beginning of that year two, multiply that by 0.55, and you figure out that, okay, it has to depreciate by $5,445. So then you would make your adjusting entry. And after year two, as you can see, the car is now worth $4,455. So the other thing I would just point out, you just go on and on from there. I would just point out the reason it's called declining balance is, look, the amount it depreciates each year tends to go down by more and more, because when you're multiplying it by a percentage, it's going to be front loaded. So most of the depreciation will happen at the beginning. Whereas with straight line method, it's just the same amount each year that it depreciates by. All right. Salvage value doesn't come into play when you have declining balance. Okay. So with all of that said, we are pretty much there. Let's try some examples. Let's try our second learning goal. Can you do what I just did? Give this a shot. So I'll just read through it. Calculate the depreciation expense on an automobile bought on January 1st, 2019, assuming today is December 1st, 2019, and we have a yearly accounting period. Okay, so use the following information. Okay, the automobile was bought at a cost of $40,000. Estimated useful life, $5,000. I haven't given you a salvage value here. I probably should have, but that's okay. You can still do it. This will be easier. And if you are using declining balance, or when you use it, the Canada Revenue Agency gives you a rate of 30% for this automobile. All right. So go through 1 through 5, pretty straightforward. All right, and here's all the problems worked out. The only thing I'd just point out is, yeah, with the whole straight line one, if there had been a salvage value, then instead of just doing $40,000 divided by 5 to figure out annual depreciation, you would just do $40,000 minus whatever the salvage value is we'll get at the end for the car. And then you divide that by 5 to get your annual depreciation. All right, folks, thanks for sitting through this long video. Please let me know if you have any questions, and we'll continue in class. Also, if you haven't, let me show you these again at the end. Just maybe give it a quick read through and make sure you feel pretty comfortable with our goals for today. And we'll keep practicing. And for making it through, here are a bunch of corgis. And here are what I think their names would all be. I've got to stop doing. Okay, sorry. I'm gonna get back to my Sunday. Have an awesome day, though, everyone. Oh wait, I'm still with you. I'm in class watching this. Okay, I'm ending this video. Thanks for watching. Let's get practicing on this depreciation stuff. Yeah.